Hello, good afternoon. Thank you for joining us today as we go through this session on payroll taxes. This is proudly brought to you by the UK Ghana Chamber of Commerce in collaboration with PwC. And my name is Gifty Mate-Trebi. I'm an associate director at PwC, and I provide payroll tax services, as well as global mobility services. I'm pleased to be your host or your moderator for that matter this afternoon. Okay, so for those of you who have had a chance to join us in previous sessions, we've looked at excise taxes, we've looked at tax updates in general, and today we'll be looking at the all-important topic of payroll taxes, and specifically, we'll be navigating the payroll tax compliance landscape in Ghana, and our panelists have been preparing to provide you with a very comprehensive guide in order for your businesses to know what you have to do as far as payroll taxes are concerned. And as we all know, payroll taxes could be very complex if you're not sure of what to do. However, they could also be straightforward if you are very much aware of what you have to do. Now, when you come to Ghana, when we are talking about payroll taxes in general, we go beyond the PAYE taxes. We also have the pensions that are also mandatory. And when we talk about the pensions, we are looking at the statutory pensions, the mandatory pensions, as well as the voluntary. We also have the one that is regulated by SNIT, also the one that is regulated by private pension service providers. So we're looking at all of these details, and that is why it is very important that when you are operating a business in Ghana, you are very much aware of all of these regulators and who you should be dealing with in a particular situation. For those of you who are members of the UK Ghana Chamber of Commerce, thank you for continuing to be a member. For those of us who are very new and would like to join the chamber, you are more than welcome to join, and we'll be sharing the joining instructions as we go along in the chat box. And we also encourage you to follow the social media handles of the chamber so that you get regular updates and prompt information as well. Okay, so we expect that by the end of this session, we'll be able to provide you with a comprehensive understanding of the Ghana payroll tax landscape, like I mentioned earlier. We'll also be able to increase your awareness of the key components and structures of payroll taxes in Ghana. And also, we believe that by the end of the session, you'll be empowered effectively to navigate common challenges that you are likely to face as a business operating in Ghana as far as payroll taxes are concerned. To help me do this today, we have very able panelists, and I'll be introducing them in no particular order. So our first panelist is a supervisor with the Ghana Revenue Authority for upstream petroleum audits at the Large Taxpayers Office. He has a career spanning over 25 years, and he has built an extensive expertise in tax administration and petroleum taxation. He actually brings a wealth of knowledge and practical expertise to the field of tax auditing, and we are privileged very much so to tap into that experience this afternoon. Ladies and gentlemen, I introduce to you Mr. Eric Anthony.
Gifty, thank you for having me.
Thank you very much, Eric. Our next panelist is an experienced pensions and regulatory professional. He has over a decade of expertise in compliance, enforcement, and policy development within the pensions industry. He's currently the head of the Standards and Enforcement Unit at the National Pension and Regulatory Authority. In addition to his professional duties, he's also an active faculty member at the National Pensions College, where he educates industry stakeholders on regulatory issues. He also brings a great wealth of knowledge to us on the pension side of things this afternoon. And we are pleased to welcome Mr. Ni Amun Otu to today's session as well.
Okay, thank you very much, Vicky. Thank you for the introduction.
Thank you very much, Lee, for honoring our invitation. Okay, so our last panelist for today, but definitely not the least, is Mr. Franklin Mensah. Mr. Franklin Mensah is the financial controller for G4S Security Services Ghana Limited. He's an experienced chartered accountant and has over 15 years experience in financial management, taxation, forecasting, and systems accounting. He has worked across various industries. And today he's going to share with us his vast experience as far as payroll taxes are concerned and how he's been navigating those challenges from a practical point of view as a business operator in Ghana. Mr. Franklin Mensah, thank you very much also for joining us this afternoon. Okay, so we can delve straight into the matter of today. I'd like to invite Mr. Eric Anthony to tell us more about taxes as business, whether existing businesses or new businesses coming into Ghana, what they have to know as far as payroll taxes are concerned, what challenges they are likely to face, and how to navigate those challenges. Thank you very much, Mr. Eric Anthony. You are on now.
Thank you very much, Gifty, and a very good afternoon to you, listeners. The matter before us today is navigating payroll tax compliance in Ghana. Let me first start off by saying that generally, there are three sources of income that are of interest to tax in Ghana. They are the income from business, income from employment, and income from investment, all things being equal. I think today's discussion is going to look exclusively at income from employment, since it is that income that feeds exclusively into payroll matters. To start off, one would ask, what is, let me share I've shared the screen so that you can see what I'm talking about. To start off, we want to look at what employment is. I've just mentioned income from employment. What is unemployment as defined in the Income Tax Act? And I mean the Act 896 of 2015. It says that a position of an individual in the employment of another person. This person can be an individual or a corporate entity, or a partnership, or a trust, a body of persons, right? Or a position of an individual as a manager of an entity other than a partner in a partnership. You are an employee if you are a position, or you hold a position of an individual, entitling that individual to a fixed and ascertainable remuneration. So if you have a fixed income, whether monthly income or periodic income, in respect of the services that you perform, you are an employee or you are in an employment. Again, for those of us in public office, if you are an individual that holds a public office, you are an employee to the state. So the Act 896 considers all these as situations of employment. Now, the Ghana Revenue Authority requires all employers to deduct taxes as source, from wages, salaries, or what we call the gains and profits from an employment situation. And this is what we call the PAYE system, meaning you pay as you earn system. An employer shall withhold tax from the payment that is made to an employee. In ascertaining the income of an employee from the employment, an employer would have to withhold tax at a certain percentage or at a certain graduated scale and pay same to the Commissioner of Ghana Revenue Authority. The obligation of the employer to withhold tax under the law is not reduced or extinguished because the employer has the right or is under any obligation to deduct any other amount. So if the employee, or let's say the worker, has some obligations and the employer has to deduct those obligations from the salary, it doesn't affect the obligation on the employer to withhold PAYE taxes and pay same to the commissioner. Or if any other law provides that the income of the employee, suffers some reduction or is subject to an attachment, the employer is still under obligation to withhold from the remuneration that is paid to the employee. Now, how do you withhold, or how do you calculate or determine the taxes that are applicable, that are supposed to be withheld? We do this by looking at the regulation which the minister has made to that effect. Indeed, the Substantive Act requires the minister to provide regulations to govern the treatment of this PAYE system, or the PAYE taxes. Now, in the regulation, which is the Income Tax Regulation 2016 LI 2244, it requires the employer to determine what we call the qualifying cash payment made to the employee during the year of assessment. And what does it say? The regulation 31 says that in accordance with these regulations, an employer shall withhold appropriate tax from qualifying cash payment made to an employee during the year of assessment to meet the employment tax liability of the employee for that year. An employer shall withhold tax in accordance with, the law and the regulation if the employer is resident in the country. So first of all, we are looking at an employer, whether an individual is the employer, or a company is the employer, or the partnership is the employer, or a trust is the employer, whoever the employer is. Once that employer is a resident entity in the country, that employer has to withhold the appropriate PAYE taxes and pay. A non-resident employer who has a Ghanaian permanent establishment has a duty to withhold the taxes, the PAYE taxes as well. What this means is that if you are non-resident, and we'll soon define who a non-resident is, but if you are a non-resident entity, and then you have a permanent establishment in Ghana, then by reason of that permanent establishment in Ghana, the employees that you have in Ghana who will be receiving employment gains and benefits would have to have their incomes subject to PAYE taxes accordingly. So the obligation is not only on the resident person, but a non-resident person who has a permanent establishment in the country as well. In the case of a non-resident public entertainer who renders a service in Ghana, for tax purposes, that entertainer will be treated as an employee of the promoter of that entertainment, in respect of which that public entertainer renders that service. So if you engage a non-resident public entertainer, you invite him to Ghana to perform that entertainment, then you, the promoter who promoted that activity, becomes the employer, and then the entertainer becomes the employee, and you have to subject the payment to the appropriate taxes. A person who makes payment to a public entertainer for a service by that public entertainer shall, for tax purposes, be treated as the employer. That's what I've just said. The general rule for taxation of income from employment is that the income shall be the individual's gains or profit from an employment for a year of assessment. So in line with Section 1 of the Income Tax Act, that says that income tax is payable for each year of assessment by anybody who has a chargeable income. The employment income, which when treated would result in a chargeable income, will fall in here. And the law considers that as gains and profit from employment in relation to a particular year of assessment. The year of assessment for the employment income shall be the same as the calendar year. What this means is that for an individual, your year of assessment or your basis period is 1st January of a particular year to the 31st of December of that same year. Unlike companies who, some of which have what we call accounting year, which ends on a different date or date other than 31st of December. In the case of an individual, your year of assessment and the basis period therein will align with the calendar year or the government's calendar year. Again, it is important to note that for individuals, you account for your income tax on cash basis. So you don't account for your income taxes on accrual basis. Unlike companies do account for their income tax matters on accrual basis, but for an individual, you do that strictly on cash basis. The income of an individual for employment for a year of assessment is the gain and profit of that individual for employment for that year or part of the year, which means that it is not only in respect of the completeness of the year or a total year per se, but even if you earn gains or profit for a part of the year, it is still an employment income which is subject to PAYE taxes. Examples as provided for in the law include salaries, wages, leave pay, fees, commissions, gratuity, as well as overtime pay and bonuses. Now, I will take a little time to talk about overtime pay and bonuses before we proceed with the other examples of employment gains and benefits. In respect of overtime, let me start off with overtime. Overtime, in the view of the law, is supposed to be received by only qualifying junior employees or junior officers. And junior employee or junior officer is a technical term and is defined. What it means is that overtime is not allowed to be paid to anybody. So if an entity or a company pays overtime to anybody, the GRA may recharacterize that transaction if the recipient doesn't qualify as a junior qualifying employee. So who is a junior qualifying employee? It means it's a junior staff member. So on your organogram, that person should be a junior staff on the organogram of that entity. Again, if that person is a junior staff, that person's employment income should not exceed 18,000 cedis per year. What it means is that if you are a junior staff and then your employment income is more than 18,000 cedis per year, then you do not qualify for this concession or this arrangement of overtime. Qualifying employment income from an employment for a year of assessment is equal to the total of all amounts that are required to be included in the income of the employee from employment for the year of assessment. So in determining the overtime and the taxes thereon, you need some elements. First of all, you need to determine the qualifying, that the person is the recipient is a qualifying junior employee. And then the amount is actually a qualifying employment income. You need to determine that as well. When an employer makes a payment for overtime work, to a junior, a qualifying junior employee during the year of assessment, the employer shall withhold tax from the total of that payment at a rate of 5% if the amount paid does not exceed 15% of the basic salary of the employee for the month. So if the overtime paid is less than or equal to 15% of the basic salary of the employee for the month, then you tax the total amount at 5%. But where the overtime paid is more than 15% of the basic salary of the employee for the month, the excess over the 15% is taxed at 10%. Okay, so we proceed to talk about bonus. Where an employer pays a bonus to an employee during a year of assessment and other bonuses paid by the employer to the employee for the year, and then the bonus paid does not exceed 15% of the annual basic, that is the annual basic salary of the employee, it shall be, the employer shall withhold tax from the gross amount of the payment. At a rate of 5%. So what this means is that if the bonus amount paid exceeds 15% of your annual basic salary or the annual basic salary of the employee, then the excess amount over the 15% will be added to that employee's income for the year and taxed at the applicable graduated rate of tax. So the amount of bonus, which is equal to 15% of your annual basic, is taxed at 5%, and that becomes your final, it's a final tax. However, if there is excess of it, that excess is added to your income, your regular income, and taxed as part of your regular income. So for bonus, there are two phases of it. One part of it is final or suffers final withholding tax, and the other part is added to your income and taxed. Now, when you have aggregated all the employment income or the gains and benefits, because salaries are normally paid on monthly basis, you divide the rate as I have shown on the screen by 12, and you see this in the next slide. So this is the rate which is applicable on monthly basis for the purpose of PAYE taxes. Now, let me just do a quick walk through this. What this means is that for any income that you get in Ghana on monthly basis, if that monthly income is up to 490 Ghana cedis per 2024 rates, or rates that are applicable today in 2024, that income will be taxed at a rate of 0. It means that you pay no tax on that income. However, if you earn more than that, then you take the 490 out, the difference, if it's whatever difference, if it's within the range of 110 cedis, then you have to pay 5% of that as tax. So if you earn 600 cedis, you only pay tax at 5% on 110 cedis, all things being equal. That is if you have taken out all your reliefs, which we'll soon talk about. So this, we are talking of chargeable income. So it means that you have already received the gross income, the assessable income, and you have treated it by taking out all the reliefs and added all the taxable components. What you get is the chargeable income. So I'm talking of chargeable income, not the gross pay per se. The gross pay which has been treated and from assessable income up to chargeable income. Now, it runs through. So if today, if you earn any amount exceeding 50,000 cedis, the part that exceeds 50,000 cedis, you pay 35% of that as tax. And then if you earn, let's say 3,896, it means that this income would go through three different rates. The first 110 will be 5%, the next 130 will be 10%, and the next 3,166 will be 17.5%, and on and on and on till you exhaust the total amount. The next we want to look at is tax withheld from overtime or bonus paid as final. I've already spoken about this one, that the 15% is final, and the difference over the 15% is added to your income and taxed in line with the first schedule. Okay, so the other forms of allowances, which are also considered as gains, part of the gains and profit of employment. As we can see on the screen, these are some of the examples. We have personal allowances. These are taxable. So apart from the basic salary, the wages and salaries that we've spoken about, if the employee also receives personal allowances of the kinds that are listed here, the list is not exhaustive, but this is just to give an idea. If the employee receives any such remuneration or any such allowances, they are also taxable. And some are the cost of living allowances, subsistence, rent, entertainment, and travel allowances. So if the employer makes a payment on behalf of the individual based on agreement or a condition of the employment, and this one we are looking at, I think, section 27 or so, where the employee doesn't receive the money directly, but the payment is done to another person, indirectly done to another person based on some agreement, that payment is still considered as a benefit to the employee, and it's calculated as part of your income. This section looks at section 94. It talks about retirement contribution made to retirement in respect of retirement fund on behalf of the employee. And then I would want to quickly skip this because my other colleagues will be talking about pension so that we can save some time. But then what it means is that there is an exemption for payment or contribution to pension, funds. And here the Income Tax Act aligns with the National Pension Act, the Act 766, to grant some exemptions to the individual for having contributed towards the pension. And I think that where you contribute or the employer contributes some extra amount by way of outside the statutory contributions, those amounts are not supposed to be withdrawn. And if you decide to withdraw them before retirement, you have to pay taxes on them. Otherwise, you cannot just go in and then take that money. There's been an amendment 1094 which requires that where the employee has lost his employment by reason of the economic hardship or COVID-19, if you go for it, yes, those ones are exempt. But I wouldn't dwell much on them because my colleagues would soon be talking about them. And this is what I was talking about. The contribution has to be up to 16.5% of your monthly income. Those ones will be exempt from tax. So, okay. So the other forms of incomes from employment include gifts received in respect of employment. So if you are an employee and by reason of that employment you receive any gift, that gift is taxable, and it is supposed to be considered, the value of the gift is supposed to be added to your income and taxed accordingly. Okay, apart from these ones, there are also what we call benefits in kind. Benefit in kind are where the employer provides goods or services free or at lower cost, or at costs which are lower than the open market value for personal use or consumption. So if the employer provides goods or services to the employee for personal use or for consumption, or either they are free or they are at costs which are lower than the open market price, those are what we call benefit in kind, and they are converted. The law provides a way to convert them and then add them to your income and tax. It is important to note that the benefits in kind do not constitute part of your total, what you call the total cash emolument. The total cash emolument concept looks exclusively at cash and cash benefits. So benefit in kind would come later after you have determined the total cash emolument. And below are some of the examples. So we are looking at where the employee has free or lower cost of housing provided by the employer for the purpose by reason of the employment. So your employer provides you official accommodation or rents a place for you, or gives it to you at a lower cost than that which you would have paid if you were to get it at the open market. Again, where the employer provides education for the employee's children free of charge or at a cost lower than the open market value. Another example is where the employer provides a car or a vehicle, provides a driver, or provides fuel or fuel coupons for the employee for private use. So the private use is important because that is what constitutes the benefit to the employee. So if the same employer provides a driver, vehicle, and fuel coupon exclusively for official use, we cannot consider that as employment gain or profit. I just spoke about total cash emolument. So what that means is that the total of all incomes derived by that person during the year of assessment for employment and any direct cash payment, but it excludes amounts which are subject to final withholding taxes. Okay, so we are going to look at what we call the motor vehicle benefit. And we are looking at where the employer provides a motor vehicle, maybe with driver or with fuel to the employee for own use or for private use. So a benefit consisting of the availability for use or use of a motor vehicle provided by an employer to an employee or an entity to a member or a manager during a year of assessment is quantified in accordance with the following rates. Okay, so from the 1st of April 2023, I think in line with the amendment at 1094, where an employer provides a driver, a vehicle, and fuel with fuel to the employee, the law provides that when you determine the total cash emolument, that is only the cash component of the employee's gains and benefits from employment. It excludes those in kind, and it excludes those that are subject to final withholding payment. So the total cash emolument, you take 12.5% and 12.5% of the total cash emolument of that employee and consider that as the employment gain. That is the benefit in kind by reason of the driver, vehicle, and fuel. Now, it is instructive to know that whatever the amount comes up to, it is limited to a maximum of 1,500 per month, which would result in a total of 18,000 cedis per annum. Where vehicle with fuel only is provided, it is 10% of total cash emolument up to a maximum of 1,225 per month, resulting in 15,000 per annum. Where vehicle only or fuel only is provided, you tax it, or you compute 5% of the total cash emolument of the employee up to a maximum of 625 per month, resulting in 7,500 per annum. So whatever the computation comes up to, if it is more than the amount that I've mentioned, you need to restrict it to this amount before you add it back to the employee's remuneration for tax purposes. Accommodation. A benefit consisting of provision of premises by an employer for residential occupation of an employee during the year of assessment is quantified as follows. So accommodation, yes, this has been the scenario since 2016. Accommodation with furnishing, you take 10% of the total cash emolument. Accommodation only is 7.5%. And then furnishing and shared accommodation is 2.5% of the employees or the person's total cash emolument accordingly. So it's just like the car element. But here, the difference is that it is not restricted. The car element is restricted to a maximum amount defined, but for for accommodation element is not restricted. Now, where accommodation is provided by the employer, the Commissioner General shall treat the amount deducted by the employer as rent expenditure. So the employer provides accommodation for the employee. The CJ would, when I say CJ, I mean the Commissioner General, would consider or would allow the amount to be deducted by the employer as rent expenditure. So how much you have spent as rent, yes, it's an allowable deduction, and it can be taken as tax deductible. Now, the above does not apply where the employer carries on a timber, mining, building, construction. Okay, so what this means is that where the employer provides accommodation for the employee on site, on the site of a timber firm or timber concession, mining firm, on their site, not their head office in Accra, but the site, and I insist on the west side, a building firm, a construction firm, a farming enterprise, or petroleum operations, where the employer provides an accommodation for the employee at such site, that provision of accommodation is not considered as a benefit in kind and cannot be quantified and added to the income of the employee for tax purposes. So, despite all that we have said, the Commissioner General shall treat an additional income earned by an employee, any cash payment made by an employer to the employee in lieu of accommodation, and tax the amount accordingly. So, if the employer pays the employee any cash in lieu of accommodation, so they haven't provided you with the accommodation either on site or wherever, but they paid you cash and described it as accommodation, it is a cash benefit and it is supposed to be taxed accordingly. So it will not go through what I have discussed already. So there is a benefit called loan benefit. A loan benefit, it consists of a loan that is provided, for a year of assessment in return for a service, whether by way of employment or otherwise, or by an entity to a member or a manager of the entity. In a situation like this, you need to quantify the benefit of that loan in a manner as prescribed by the tax law. Where the loan is from an employer to an employee, condition 1, Condition 2, where the term of the loan does not exceed 12 months, or where the aggregate amount of the loan plus any similar loans that have been given in the previous 12-month period put together will not exceed the 3 months basic salary of the employee. And then the quantity of the payment that is has not paid, the quantity of the payment is nil. Then it is considered that this concession will be applicable. Now, if we have a situation other than that, then that benefit is quantified and added to the employee's income and tax. And it's supposed to be a quarter of the Bank of Ghana rate, the rediscount rate, for that year of assessment, that interest which would have been determined through the application of the Bank of Ghana rediscount rate, less the interest which the employee actually paid by reason of that benefit. That difference, you take a quarter of it, and then it's considered that as benefit in kind. Okay, so it's been shown here. The loan benefit to be taxed. So when those conditions are met, and it's considered as a loan benefit, that benefit, when you want to quantify it and add it to the employee's income and tax, this is the formula. It's a quarter of the loan amount times the BOG monetary policy rate times time. Yeah, of course, because it's a loan, you are holding it over a certain time. So that time less the loan amount you have actually received times the interest, that's the concessional interest rate that your employer has given you, charged by, of course, by the employer, times the time that you are holding the money. So the difference between the actual interest which you ought to have paid and then the actual one which you eventually paid, you take a quarter of it as the benefit. Okay, so the loan benefit is determined on monthly basis. Any other allowance or benefit paid in cash or given in kind, if they are derived by that individual during the year of during the year from employment, any other. So apart from those that we have mentioned, if there is any other benefit, whether cash or in kind, which the employee received during the year by reason of the employment, we're saying that that is equally taxable. And these are examples of some of the allowances that our survey has revealed across the various industries, companies, or tax-paying public. As you can see, child education allowance, responsibility allowance, instructor inducement allowance, general service allowance, risk, house help, cook, steward, watchman, garden boy, and the list is not exhaustive. So I want us to proceed to talk about some of these allowances and how we treat them. So I just mentioned domestic servant, that's garden boy and cook and all those ones. How do we treat those ones when it comes to taxation? Yes, the use of domestic servant necessitates that we classify them into two. The first group comprises of the garden boys, watchmen, and others whose duty or responsibility is to keep watch over the property. So where the property is the property of the company, it means that these gentlemen, as I've mentioned, are keeping watch over the property of the company. So they are not there per se in the interest of the employee, the resident person, or the occupant per se. They are not there to serve the interest of the occupant, but they are there to protect the property of the employer, which is who has employed the employee who is occupying the building. In that sense, we cannot consider their activities as benefit to the employee. But where the garden boy, the watchman, and others have been assigned to take watch or to have the responsibility to keep watch and protect and maintain the property of the individual employee who is the occupant, then it means that by reason of the fact that the property belongs to the individual, their contribution constitutes a benefit to that individual who is the occupant, and the employee. So their incomes, their remuneration will be added to the employment gains and benefit or the remuneration of the occupant and taxed. So we need to make that distinction clear. If they are watching over a property which is for the company, you cannot tax it. But if they are watching over a property which is for the individual occupant by reason of his status as the MD or his position in the company, then it should be taxable. And then we come to the second group. The second group is the case of the stewards and cooks, whose work is to provide personal services to the employee, that is the occupant of the house. In this group of domestic servants, it is the employee who receives the benefit of the service they provide. In that case, their remuneration should be added to the emolument of the employee and taxed as benefit in kind, because the employee is living in, whether the employee is living in his own house or is living in the accommodation provided by the employer, insofar as these people are in there, these stewards are in there to serve or to provide personal benefits to him, those incomes are supposed to be added to his income and taxed. Okay, so we have spoken a lot about incomes that are taxable. Are there some incomes that are also in the nature of employment income but are not taxable? Yes, and Section 7 of the Income Tax Act speaks to that. So let's go through them. Any final withholding payment. So if there is a fine and there's a benefit which has suffered the final withholding payment, it doesn't come into this discussion at all. A discharge or a reimbursement of an expense incurred by an individual which serves the proper business purpose of the employer. So if your employer sends you to go around and render service or do something on behalf of the employer, I mean, that serves the proper business of the employer, and then they reimburse you that money, or you used your money to do that and then you've come back to take it, it cannot be considered as an employment benefit or gain. So that reimbursement cannot be. Now, of course, in line with Article 68(5) of the Constitution, the salary, allowances and facilities, pension and gratuity of the President of the Republic of Ghana is exempt from tax. A capital sum paid to a person as compensation or gratuity in relation to a personal injury suffered by that person or the death of that person paid to another is also exempt from tax. Income derived by an individual entitled to privilege under the diplomatic immunities law and other specified conventions, once they are there, we don't tax them. Okay, so examples of some of the final withholding payment: an overtime payment made to a qualified junior pay employee is final withholding payment. And then I've spoke about this bonus up to 15%. Okay, then yes, I've spoken about this one as well. Okay, and then we have what we call medical, dental, and health insurance expenses incurred by the employee. Those ones are also exempt. Those ones are exempt, but there's a condition. Those services or payment must be available to all employees and must be provided without discrimination. So, for example, all junior staff should enjoy the same medical services and payment, all senior staff the same category, and then all top management staff enjoy the same category. So if junior staff and top management staff are not receiving the same category of service, we can't say we cannot say it's discriminatory. Discriminatory is where one junior staff is receiving something higher or different from the same another junior staff in the same category with him. Okay, and then of course, a payment for providing passage of an individual to and from the country, Ghana, in respect of the first or employment of that individual by the employer, or the termination of that employment where the individual is recruited or engaged outside the country. And B, where the employee is in the country exclusively for the purpose of serving the employer, and where is not a resident of the country. So in a case where that employee comes to the family and then or travels to the family, and then the employer takes care of their travel expenses, it is only that of the employee which is exempt. But that which is paid in respect of the other members of his family will be added to his income and tax. It's taxable in his hands. A payment made to employee on non-discriminatory basis, which by reason of the size, the type or frequency of the payment are unreasonable and administratively impracticable. So what this means is that if a payment is made to a group of employees or the employees, and then you cannot, by reason of its size, maybe it's too small, or the type is difficult to apportion, to be able to tell, segregate that this employee A had so much, B had so much, and then you cannot reasonably tell, the law says that avoid the tax on it.
Hello, Eric. Yes, so if we can go through the compliance deadline so that participants can know when they should file their returns, when they the PAYE returns, and then also the annual returns, when they should be filing those as well. That would be
okay.
great.
Okay, that's fine. So straight away, what we are supposed to know is that for employees, previously under I think section 125, they were not supposed to file their returns previously, annual returns. But now, per amendment 924, employees are supposed to file their own returns, and they're supposed to file it 4 months after the end of the basis period. So by April ending, and we've already said that their basis period starts from January to December. So from the next year, that is the ensuing year, from by the 30th of April, they are supposed to file all their returns, their annual income tax returns. And by Regulation 12, the employer rather has to file a schedule. So if you're an employer, you file a schedule indicating the number of monthly PAYE payments that you have made, the people involved, the amount involved. You have to file those schedules with the Commissioner General. Now, by reason of the monthly payment, by on or before the 15th of every ensuing month, the employer has to file what we call PAYE returns and pay. The return is in a prescribed form by the Commissioner General, and then it's supposed to extract the details of the gross amount, their reliefs. Of course, I didn't have time to talk about reliefs, but those who have got the relief cards approved by the Commissioner General, yes, you subject their accessible income to a reduction by reason of those reliefs, and then you state their chargeable income, the taxes that have been deducted and payable, and then you pay same to the Commissioner General, and then it will hit their ledgers accordingly. So in terms of the filing, yes, that is the responsibility on the employer, but the annual returns is the responsibility of the employee.
Hello, Eric. Thank you very much. Thank you for
I don't have that. Okay, that's fine. That's fine. Maybe we can answer the rest during the Q&A section.
Absolutely, absolutely. Thank you very much. That has been very insightful and comprehensive. And I believe that our participants have picked a lot from that, and they are ready. They are getting ready with their questions. So a kind reminder to our participants, when we get to the Q&A session, you can actually raise your hand and then we'll call you. Also, you can start putting your questions in the chat box, and we'll be collating those and addressing each and every one of them during the Q&A session. So once again, thank you very much to Eric for this very comprehensive presentation. So we can now invite Ni Amu to take us through the pensions side of things. We've seen how the taxes should work. We've seen what the deadlines are on that front. And it's important that we also see what pensions, what the pension requirements are for businesses. So on that note, Niamu, kindly take over and take us through the pension side of things. Thank you.
Thank you very much, Gifty. I'll just share my screen shortly, and then we can start. Okay, so I hope I'm visible. My screen is visible.
Yes,
Okay.
we can see your screen.
Okay, okay. Good afternoon, participants. Good afternoon, panelists. Thank you for the opportunity to speak on the three-tier pension scheme. So our operative law is the National Pensions Act 2008, simply referred to as Act 766. We have two other instruments, legal instruments, or what we call legislative instruments that are subsidiary to the Act. That's the Occupational and Personal Pension General Regulations, LI 1990. And then we have the Basic National Social Security Regulations, that is the LI 1989. So LI 1989 superintends over the Tier 1, and then 1990 superintends over Tiers 2 and 3. So just to give a certain background to why we are where we are. Prior to January 2010, we knew of SNIT alone managing pensions. Of course, there were some other pension schemes. We had the CAP 30, that predates SNIT, actually established by the our colonial masters, or former colonial masters, as the British government. And then we have what we have on the campuses, the public universities, the Ghana Universities Senior Staff Superannuation Scheme. So basically, why we have a three-tier pension scheme, and the law was reformed in 2008. It was mainly fueled by agitation by public workers. They saw a certain disparity between the benefits they were receiving. That's those colleagues that had the option to stay under CAP 30 and those who opted to be under the new SNIT scheme at the time. That's in the 60s. At the time they were retiring, they felt that the benefits were not commensurate. Looks like the CAP 30 was enjoying, CAP 30 beneficiaries were enjoying better benefits. So a presidential commission was set up under the late Dr. T. Ebediaku in July 2004. A lot of research was done, engagements across the country. We visited other countries, the commission did. And the conclusion was that it was necessary to borrow from the different models of pensions we have, mainly the defined benefit and defined contribution. And the result of that was a three-tier system. The act that was promulgated, as I've already mentioned, is the National Pensions Act in 2008. It established the NPRA as a regulator of pensions in the country, all pensions. And then it was implemented on 1st January 2010. So the three-tier pension scheme in summary, so it's regulated by the National Pensions Regulatory Authority. We have the first tier that is mandatory and is also referred to as the Basic National Social Security Scheme. Is managed by SNIT, Basic National Social Security Scheme, because any beneficiary to the scheme that qualifies to receive benefit will get that basic income during retirement. It pays a monthly pensions, and if you don't meet the requirements, it pays you out a lump sum. There are other benefit conditions that beneficiaries or participants in the scheme enjoy. That, let me just to mention, to highlight, there's invalidity pensions. We have retirement or permanent immigration benefits for expat workers. There's also early retirement for those who want to go on retirement early. That's from between 55 years and 59 years, 11 months. Then there's survivor's benefits. That is, if the participant of the scheme meets their unfortunate demise, their nominated beneficiaries enjoy the benefits in a distribution that the participant or member has indicated to the scheme. Tier 2 is also mandatory, also called the occupational pension scheme or work-based pension scheme. It's privately managed. What that means is that we have private companies or private businesses that are licensed and registered by the NPRA, who oversee the administration of the Tier 2 scheme. The Tier 2 scheme pays out a lump sum, basically your entire amount accrued as a benefit is paid to you in bulk. So the difference between the Tier 1 and Tier 2, even though they are both mandatory, but the differences are Tier 1 is managed by a public institution, SNIT, Tier 2 is privately managed. Then the other difference is that the benefit you typically would receive from Tier 1 when you meet the minimum conditions is a monthly pensions. And for the Tier 2 is going to be a lump sum. Tier 1 is what we call a defined benefit scheme. I mentioned minimum requirements because there's a formula that determines the pension that you earn. Tier 2 is basically compounded value of contributions made over your working life and interest earned from investments made with those contributions, less expenses. Tier 3 is what we call the voluntary pension scheme. Two main schemes there, the Provident Fund scheme and personal pension scheme. It's also privately managed. It also pays out a lump sum. The primary target for Tier 3 is informal sector workers, but it also applies to formal sector workers who intend to make additional voluntary contributions. Coverage of the 3-tier pension scheme is for all employees in the formal sector. It also covers informal sector and all self-employed persons. Employees, this is for the formal sector workers, especially to the mandatory schemes. Employees below 50 years as at 1st January 2010, it was mandatory for them, but it was optional for those who are above 50 years, obviously for transitional reasons. So maybe just to go into further detail with regard to the Basic National Social Security Scheme, I've already mentioned that it's mandatory for all employees in the formal sector, especially the public and private sectors. Then it's governed by SNIT, the board of SNIT, who are referred to as trustees. Minimum contribution there is, or the contribution that you're supposed to make there is 13.5%. And minimum age for membership is 15 years, maximum is 45 years. I'll explain soon where the 45 years becomes very relevant. So I mentioned the benefits you receive from the SNIT scheme, old age pension. I've already mentioned survivor's benefit and invalidity. Tier 2, already mentioned that it's second tier and is fully funded. Yes, your lump sum benefits is based on the level of contributions. For the Tier 1, your benefits is based on the salaries on which your contributions were made. So if you earn better salaries, then you have the chance of having a higher retirement benefit. The Tier 2 is operated and managed and governed by trustees who are licensed by NPRA. Your benefits are preserved until retirement, or you can have an earlier withdrawal. Yes, and for Tier 2, you can do what we call porting because there are multiple operators within the Tier 2 space. You have the option to move from one trustee to another, but there's a caveat. Because Tier 2 is work-based, what that simply means is that your choice of an operator will be managed by where you are employed. So typically, a particular employer would have enrolled its employees with a specific scheme under a specific trustee. This would also work under the Tier 3 where we have the Provident Fund schemes. On retirement or earlier death, benefits are paid out in a lump sum of money. Then there's a special arrangement for tier 2. The law says if you are 50 years and you are unemployed or self-employed, you can withdraw your pensions in whole. One might ask, what does it mean to be unemployed? How do you qualify as unemployed? So we use a definition in the Labor Act. It says that if you are out of work and you are actively looking for work, so one of the requirements when you are making an unemployment benefit is to submit yourself to the Labor Department and get certified as an unemployed person. Basically, what they'll be doing is to register you in their book. And what that registration is supposed to do practically is that when there's an opportunity for work, you'll be called upon. However, we are also using this as a way of certifying one as unemployed, but as part of our validation. So what will happen is that the Labor Department, you do the application to the Labor Department, they submit the certification to NPRA, we do a verification or validation of your application. We also check with SNIT to check whether you have received benefits, salaries in the past few months. If you have, then we might not consider you. You might be disqualified for unemployment benefits. Basically, it means that you have been deceptive. Funding of the mandatory first and second tier pension benefits. So I know I'm talking to employers, but I also know that you are employees, and pension is also of concern to you. And if you appreciate what should be done for your employees, it's easier for you to comply with the law. And so the mandatory contributions broken down in total is 18.5%. This comprises a 13% contribution from the employer and a 5.5% deduction from the employee's salary. The employer's contributions are not to be deducted from the employee's salary. For SNIT, 13.5% is remitted to the scheme, out of which 2.5 is remitted to the NHIS, and SNIT pays pension benefits based on 11%. What I mean by that is SNIT is considering the 13.5% contribution as contribution made by you, but it's only going to retain 11% of that to fund the benefits they pay. And from the 18.55% of it is paid to the second tier. Okay, the third tier. I mentioned that the Provident Fund scheme is also a work-based pension scheme. So it's also dictated by your place of employment. However, as an individual, you are permitted in the formal sector, you are permitted to do additional contributions outside of the mandatory 18.5% contributions. Just for our note, Provident Fund schemes can be funded, when I say funded, I mean contributions, can be funded by employees' contributions alone, by employers' contributions alone, or a mix of both. Typically, you find that employers take up the contributions. We found out that it's used as an incentive to retain employees. So you have a maximum of 16.5% to be put towards the voluntary schemes. However, this is for tax purposes. Beyond that, you are still permitted to make contributions to the pension scheme. So you can withdraw your benefits. There's a tax bar, as my colleague with the tax authority, maybe let me say my senior, because he exceeds me in years of work and experience. As my senior has mentioned, there's a tax bar if you withdraw your contributions, particularly that for which you enjoy the relief. Before 10 years, there's a tax element. The scheme would have to, the scheme would withhold from the benefits that you withdraw. That is 15% of the amount withdrawn, and that is paid to the GRA. So for the informal sector, I mentioned that the third tier has a special focus for the informal sector. And it says that they can pay up to 35% of contributions of, 35% contribution of declared income as pension benefits. Of course, for a lot of workers in the informal sector, the tax arrangements are not too clear. But I believe that there are a lot of informal sector or self-employed workers or business owners that own enterprises. And because the payee tax arrangement applies to them, I believe that they can enjoy that tax relief when they make contributions with regards to the third-tier schemes. And the entry age for third-tier participation is 15 years. So for the informal sector worker who has an option to contribute to the tier 1 and tier 2, where the informal sector worker or self-employed person is not contributing to tier 1 and tier 2, their contributions made to the personal pension scheme, if they so join, is split between 2 accounts, a savings account and a retirement account. And for the savings account, there can be early withdrawal. Of course, if there's a tax relief, there's a tax bar on the benefits up to 5 years. And for the retirement account, that is held onto retirement, where the individual can make a withdrawal. There's a recommendation for those who are in the informal sector who are not going to enjoy monthly pensions. And so our life insurance company, there are life insurance companies that are actually selling annuity products. Basically, an annuity product is a life insurance product that converts a lump sum into periodic payments. And it has a life insurance component to it. It mimics the tier 1 that's managed by SNIT. So tax reliefs, contributions, benefits, investments. So for contributions, up to 18.5, as I've mentioned, up to 16.5% for formal sector for tier 3 contributions, and up to 35% for informal sector workers on declared income. I've given the context in which that would typically apply. For benefits, tier 1 and tier 2 benefits are tax exempt. For formal sector workers, tier 3 benefits withdrawn after 10 years are tax exempt. Obviously, retirement benefits are also tax exempt. Survivors benefits are tax exempt. Invalidity pensions is tax exempt. Unemployment benefits is also tax exempt. Informal sector workers withdrawn after 5 years, where there's a tax relief on contributions, then there's a tax exemption. There's a tax bar for 5 years. You can only enjoy the tax relief after 5 years. Investment income for pensions are also tax exempt. I didn't mention, but there's a benefit under the tier 2, tiers 2 and tier 3, where you can commit your benefits as collateral for mortgage, for acquisition of a primary residence. It's even indicated here as 0.7. And what we say there also is that for tier 3 benefits, where a withdrawal can be made towards the mortgage payment, if there's a withdrawal made by the individual, it's paid to the mortgage provider, and it's also tax exempt. Pension qualification decreased from 20 years to 15 years. This is particularly for the tier 1. And so for the tier 1, once you qualify for pensions at 60 years, the SNIT scheme is going to pay you a guaranteed pensions for 20 years. Previously, under the old law, it was 15 years. What I mean by guaranteed pension is that if you live beyond 80 years, that means 60 plus 20 years, 80 years, SNIT will continue to pay you pensions. There's a requirement that you are supposed to sign a life certificate. Yes, and if you are not able to go to the office, SNIT can arrange for their officers to come to you for a certification. That is just proof of life. However, the 20 years guarantee period, or previously 15 years, is just to cater for your nominated beneficiaries. What it means is that if you meet your unfortunate demise before you are 80, whatever years is left to 80, the benefits that should have been paid to you will be accrued and distributed in the proportions that you've determined to SNIT. The survivors' benefit computation has been increased from 12 to 15 years. Sorry. I think I've mixed up. What I was explaining was for the survivors' benefit computation. It was 12, is moved to 15. The 20 years and 15 years is for the computation of SNIT benefits. Initially, for you to qualify for SNIT pensions, you should have contributed for 20 years. It doesn't have to be continuous, but minimum 20 years. Now it has been reduced to 15 years. What it means is that you qualify for monthly pensions earlier than under the previous law. That's the PNDC law 247. So it means that if you started work at 25, by 40 years, you have already qualified for pensions. Of course, you cannot go on retirement at 40, but your pension benefits start to count. You earn something you call a pension right, which is 37.5% of an average of the salaries that are used to compute your pension benefits. And for every additional number of years worked, up to 40 years, you are going to earn an additional 1.125. So you get a total, if you work up to 40 years, you get a total pension right of 40%. 60%. And that's 60% of the average of your best 3 years. Sorry for the mix-up. Survivor's benefit, it used to be 12 years, it's increased to 15 years. And pension qualification used to be 20 years, and now it's reduced to 15 years. For tiers 2 and tier 3 private pensions, we say there's better control because the arrangement is that every scheme to which you contribute, there's a board of trustees that superintends over the scheme. And that board of trustees is comprised of a representation from the sponsor of the scheme. So if it's a corporate trustee, then they'll have a representation on the board of trustees. Then you have representation from the employers, basically what we call the member nominated representation. So that is for those who are actually beneficiaries of the scheme. And the law requires the scheme to have at least one person we call an independent trustee that is supposed to serve as a security. Basically, an individual who is well-versed in pension and pension investments and pension management, who is supposed to give independent opinions to the scheme. That's basically best practice when it comes to corporate governance. Portability or transferability of your pensions, tiers 2, tiers 3, where there are multiple service providers, you have the option to move. For tier 2, you are barred because it's work-based. But when you leave employment, you have the option to move your pension benefits to the scheme of your new employer. You also have the option to keep it at your previous employment. However, if it's an employer-sponsored scheme, that is a scheme that is designed purposely for a particular employer, the requirement is that if you make the option to move to the new scheme, then that is fine. But you do not have the option to leave it. If you fail to make the nomination to transfer, the employer-sponsored scheme is required to keep it on preservation with a master trust scheme under a corporate trustee. So this is just for notes for employers who have the intention of having an employer-sponsored scheme or already run one. Then the better pensions is basically to explain that we have expanded the pension options for an individual who is working. Then the fact that it's privately managed, basically we are diluting management. You don't just have SNIT, you have other persons. And so it's creating some diversification in terms of those who are providing you pension benefits. The management of the 3-tier pension scheme, we have a tripartite structure. We have trustees. I've already described the composition of the board of trustees. And then we have pension fund managers and we have pension fund custodians. So basically, pension fund managers are advisors to the board of trustees. They advise on on investment of pension funds. And the custodians are those who hold the pension fund assets. So they receive contributions. And when investments are to be made, they are the ones or the entities that are mandated to settle. When there are maturities from those investments, the funds or proceeds from those investments are deposited with the pension fund custodian. And we'll typically have banks that are licensed by BOG, registered with SEC, that's the Securities and Exchange Commission, as custodians. They are the ones who serve as custodians in the pension space. The fund managers are investment advisors who are licensed by the SEC. So these are all licensed entities, they are regulated entities who are being brought into our space to add value to the process of pension management. The Board of Trustees, broadly, their responsibilities cover administration of the pension scheme, governance of the pension scheme, and also appointment and oversight of the service providers they bring onto the scheme. It wasn't mentioned there, but the other service provider on the scheme is the auditor, an external auditor who is supposed to be independent of the scheme by virtue of their professional dictates and by virtue of the Act, National Pensions Act, who on an annual basis would audit the scheme to give a fair opinion on how the scheme has been managed. And for that matter, the scheme is required to produce an annual audited report that is meant to be made public to the schemes. NPRA, what are our responsibilities or functions? We are responsible for ensuring compliance with the National Pensions Act. We register pension schemes. We have oversight over the tier 1, tier 2, tier 3. When I say tier 1, I'm talking about SNIT. We approve, regulate, and monitor trustees and service providers. We establish standards and rules and guidelines for management of pension funds. We are responsible for sensitization together with the service providers, particularly the trustees. We receive and investigate complaints. So from time to time, we receive complaints from workers. We receive complaints from the schemes and service providers themselves, and even from employers, from issues they have with their service providers. We also receive and investigate grievances from pensioners and provide redress. We advise government on issues regarding pensioners and pensions generally. And we are also responsible for promoting and encouraging development of the industry. Protections under the scheme, we are currently moving into what we call a risk-based regime, where we use risk management as a tool to supervise the industry operators and also to give guidance. Basically, risk management allows us to have a certain foresight based on historical data, so that we preempt any issues, potential issues that may arise on the scheme. There's a tripartite structure that I've already described: trustees, oversight, appointing fund managers and custodians. The independent trustee and their responsibility, member-nominated trustees, directors, basically giving members an opinion in the decision-making with regards to their pension management. Restricted investment regime, so we have an investment guideline that guides schemes and trustees as to how pensions should be invested. So there are certain approved asset classes, securities that you can invest in, and also limits on exposure to issuers of those securities. The law requires, under Regulation 2 of LI 1990, requires corporate trustees to appoint compliance officers, and soon we are going to require every scheme to have a compliance officer. Basically, they are supposed to be liaisons with the authority on issues of compliance. So if there are any issues that we want to keep the schemes updated from, apart from the public information we put out there, we liaise with these persons, we educate them so that they can guide those who are managing and have oversight of the schemes. We have a sanctions regime that we use to keep our operators in check. Basically, for the sanctions regime, we are looking at financial penalties, we are looking at withdrawal of licenses or cancellation of registration, we are looking at reprimands, we are looking at name and shame, we are looking at prosecution. We do on-site and off-site inspections. On-site basically means that we visit the entity and scrutinize their books. And then off-site means that there are certain regulatory reports that are submitted by the various licensed and regulated entities in our space on the operations of the scheme that help us to do a certain determination on the operations of the scheme, the health of the scheme, whether they are in compliance. And now that we're going risk-based, we'll be using certain risk metrics to ascertain the risk-return relationships, just to make sure that you're really getting value for your contributions. We have a prosecutorial mandate from the Attorney General's Department, EI 26, that allows us as a public institution to prosecute on issues of pensions offenses that arise from our Act and our LIs. And so issues of non-payment, if you have an entity that's operating within the industry that is not properly licensed or registered, you're supposed to submit certain documentation you have failed to. Even as an employer, you're supposed to submit contribution schedules. We can, if you fail to do it administratively per our requests, we can drag you to law and get you sanctioned for it. We can sanction you ourselves. Prosecutions, we can, if you, the operators, they misappropriate funds, if there are issues of fraud, if there are issues of money laundering, together with other state institutions that have that mandate, we can prosecute you. The role of the employer, which is actually very important to webinar today. So basically, just for your information, when it comes to deduction and remittance of contributions, the minimum salary on which contributions can be deducted is the monthly equivalent of the prevailing daily minimum wage. And what we have as of 1st January 2024 as the monthly equivalent is 490 Ghana cedis. Maximum salary, and this is specific to tier 1, what we call the maximum insurable earnings, is 52,000, and this was announced as of 1st January and is subject to change. What this means is that you compute 18.5% on the actual salary of the employee. However, SNIT is mandating that or requiring that you pay only contributions, you pay contributions only on 52,000. And the requirement is that whatever the excess is must be remitted to the tier 2, which is also a mandatory scheme for the benefit of that particular employee. It does not reduce your obligation. You are supposed to facilitate pre-tax deduction for tier 3. As I mentioned, each employee has up to 16.5% that they can do pre-tax into the tier 3 scheme, whether it's a provident fund scheme or the individual is participating in a personal pension scheme. The law enjoins the employer to facilitate that deduction on the payroll for the benefit of this employee. And you are required, it's mandatory, it is statutory, to make the 18.5% mandatory contributions for all staff. For staff who are aged 45 years and are first-time participants in the first and second tier, the mandatory schemes, the law requires that you pay all 18.5% to the tier 2 scheme. Just to repeat, where a staff has never participated in the tier 1 and tier 2 scheme, they've never worked in the formal employment. You normally find this perhaps in those who are in the manufacturing, security companies. You typically find that situation. There's also that situation where those who are under the CAP 30 or the with the universities where they are participating in the GUSSS, that's the Ghana University Senior Staff Superannuation Scheme, who have never contributed to the 3-tier pension scheme. You'll find that they would be new participants in the tiers 1 and 2. If they are age 45 when they first join you, then they would have to contribute the total 18.5% to the tier 2. And for them, what the law recommends is that on retirement, their lump sum, 75% should go to purchase an annuity, as I've already described, and 25% is paid as a lump sum from the scheme.
Eloni, thank you very much. Can you speak about the deadlines now?
Okay. So for us, for employers, the major or only deadline that you should be very worried about is the payment of contribution, which is 14th of the ensuing month. So what it means is that, for example, we are in November. So for October contributions, today is 5th November. So by 14th of November, the expectation is that contributions must be paid for years 1, 2, and 3. Now there's an obligation to that. If you fail to make those contributions, you incur a surcharge, which is 3% of the contribution you should have paid per month. And it compounds monthly until the payment is made. And it attracts actually a criminal offense if you fail to pay. So if administratively we are not able to recoup or recover those monies from you, you'll be charged and served at court to pay the contribution plus surcharge, and also a penalty that, as stipulated by the law, it says up to 2,000 penalty units. That converts to 24,000 for each month you default. Thank you. Gifty.
Thank you very much, Ni Amu, for such an educative presentation. I believe our participants have learned a lot from this session as well. I see some questions popping up. We'll be looking at those in a moment. But before then, I would like to invite Mr. Franklin Mensah to give us some brief remarks from a practical perspective as the financial controller for a UK business operating in Ghana. So, Mr. Franklin Mensah, you have the floor now.
Yeah, thank you very much. And welcome. I want to welcome our cherished listeners as well. I'll be looking at it from a practical point of view. In implementing our taxes and ensuring that we align with the tax regulations, as well as the business laws within the country, we need to look at the softwares we use in computing our taxes. Some of the softwares are tailored to suit particular organizations, especially the off-shelf softwares which we buy. Whichever country the software is coming from, the manufacturers ensure that they are set to meet the employment regulations and tax laws. And for us, what we need to do is to work hand in hand with the programmers of these softwares to ensure that they align with our country's regulations. There are instances where people use softwares and realize at a later date that certain computations or programming within the system do not conform to the GRA requirements. And that, if care is not taken on time, can lead to unwanted penalties. 2, we also need to ensure that the calculations are accurately done, and they align with all our requirements. There should be no ambiguity in defining or describing a particular element within the tax law. In Eric's earlier presentation, he did enumerate a lot of benefits and not a lot of allowances within the payroll space. When care is not taken, organizations have different names or different descriptions to what they pay to their staff. And we need to align these to the GRA schedules, which we learned earlier on from Eric. There should be no ambiguity. One experience we had was an allowance being paid and called performance bonus allowance. This is an allowance that is paid on monthly basis, but per the name, just by bearing the name performance bonus allowance, the programmers thought it was supposed to be a bonus. And if it is a bonus, then the calculation differs. If it's an allowance, that must be added to the taxable income and paid on monthly basis. If care is not taken and this is mistreated, at the end of the year, when the tax auditors from GRA come to assess your liabilities, you'll be surprised what will come out of it. They may reclassify it as a bonus and tax it by that rate, or aggregate every payment you have made on monthly basis and then apply the bonus rate. But what we did was to seek clearance from the GRA office. So if there is any kind of ambiguity in the treatment or description of an element within the tax space, the best thing to do is consult your tax professionals or visit the GRA office in writing. Make sure that these things are in writing so that you can have proper documentation of them when the tax auditors come around. If it is a bonus, like Eric said earlier on, then 5% is taxed up to 15%. The excess of this is added back to the taxable pay and taxed at the graduated rate. But where it's allowance, then that allowance must be taxed every month, treated as a taxable pay, added to the taxable pay, and taxed on monthly basis. These are two different treatments, and we need to be particular. There may be other allowances, depending on which organization we're talking about. But what we need to do to avoid these penalties is to ensure that whatever description or name that we have for a treatment, we should ensure that it aligns with GRA's expectations. If not, then we need to consult them. One thing also businesses need to look at is reconciliations. GRA has a template that at the end of the month, each business files. And this template enumerates the tax rates and what GRA expects to be the taxable amount for each individual. As we compute, we use systems, software, different various softwares. At the end of each month, we need to extract our data and compare it to the GRA template. If one does not have that template, what you can do is to design a template. You can use your Excel to write any model that suits the requirements of GRA. Once you import your data into this, it acts as an independent check on your software or your payroll system, just to ensure that you are in line with the expected tax rates. If not, we'll be surprised at the liabilities that will come forth at the end of the day. I'll also require that businesses seek professional guidance in ensuring or giving them the assurance that the tax rates being implemented within the organizations fall in line with our tax legislation. Once in a year, one can consult their tax professionals to perform a health check. It's very important on the payroll taxes. This gives you an alert earlier on areas that you need to focus on in order to ensure that you rightly correct those errors before it gets too late. They can also make recommendations as to how you can improve your systems to avoid any tax liabilities. Remember, the least mistake or the least time that you waste can lead to fines and penalties. Of course, nobody wants to incur any unwanted liabilities. So we need to act promptly. Also, one thing we need to look at is the tax environment that we operate in. For us, we should be mindful that it's a very dynamic system that we have here. The tax rates get changed anytime within the year or within a year or within a particular year. Each year, we have changes that come in. And we are all witnesses to this. We must make sure that we are abreast with the tax changes, the tax laws and legislations, and ensure that we update our payroll systems on time to avoid surprises at the end of the year. By proactively addressing some of these issues and challenges, businesses can avoid financial losses, they can avoid interest, they can avoid penalties and fines. These monies can go back to be invested into their businesses. One thing also to be mindful of is at the end of the year, we need to also run a comprehensive reconciliation. Aside the monthly reconciliations, at the end of the year, we need to run a consolidation on all the reconciliations that we have done, so that if anything is missed along the line, we can easily identify them and then mitigate our losses. Thank you very much.
Thank you very much. Thank you for that. And I really like the part where you refer to the tax consultants. And I want to remind our participants that PwC, we are here to support you. So feel free to reach out. Thank you very much once again, Franklin. That was very educative as well. Thank you. And I believe that most of our participants have similar challenges that you've had, and the knowledge you shared, they would apply those to their daily activities to navigate the challenges in payroll compliance matters as well. So once again, thank you.
Thank you, too.
Right. So now we can delve into our Q&A session. And we have our first question is from Ebenezer. And this will go to you, Eric, if you could take this for us. So Ebenezer would like to know how to compute PAYE for an employee who is paid net salary, and in which regard the company pays all taxes or is responsible for paying all taxes, and the individual also enjoys car and accommodation plus other allowances. So essentially, the employee, per the arrangement with the employer, is not supposed to pay anything. So Ebenezer would like to know what should they consider in computing such tax for such an employee? So Eric, if you could kindly take that question for us.
Thank you very much, Gifty. So if I got Ebenezer's question right, Ebenezer wants to know how taxes are computed in the case of an individual who receives net salary because the employer employer suffers the tax element on behalf of the employee. Is that correct?
That's correct, yes.
Okay, good. And additionally, that same employee has an official vehicle.
Yes, official vehicle accommodation plus a host of allowances, but they are not required per the agreement to pay any taxes.
They are not required per the agreement to pay any taxes. Okay, that's fine. That's good. Thank you. Ebenezer, it's a straightforward matter. You can have whatever arrangement you want to have, contractual arrangement you want to have, business arrangement, business system, whatever you want to do, you are at liberty to do. Insofar as they are fine with you, you can go ahead. But there is a barrier somewhere. And the barrier is that you cannot have a contract which contradicts a law in Ghana. So if your employment contract says that, oh yes, you have these allowances, they are not supposed to be taxable, fine, we wouldn't fault you. But remember that that provision is contrary to a law of Ghana, and no other law than the income tax law. It has a strict, like, it provides a strict liability. So what we will do is that, much as we respect the sanctity of your contract, insofar as it contradicts a statute of the land and proceeds to contradict the constitution of the land, that provision in the eyes of the tax official is null and void. Let me start from the constitution. When you look at Article 41J, that speaks to the duties of the citizen. It requires that each citizen or each individual or each citizen of Ghana has to disclose their incomes honestly to the appropriate agency and then pay their taxes accurately or appropriately to the GRA. So looking at, and this is a constitutional provision, and the Constitution is the mother law of all the laws in Ghana, and nobody is above it. So when we leave the Constitution, we come to an Act of Parliament, the Income Tax Act 896. Section 4 says that for employment income, all the gains, the benefits, the total gains and benefits that are availed to you or paid to you as an employee by reason of that employment is taxable, and proceeds to put responsibility on your employer to withhold the appropriate PAYE taxes. I mean, I'm happy with what Franklin said, in line with what Franklin said, and pay same to the GRA. So this is the legal background to what I am going to say. In the instance that you have provided, the tax is supposed to be a responsibility of you, the employee. You are supposed to pay the tax. The tax burden has to come to you. The employer would only deduct. So you must carry the burden of the tax. So if the employer decides to carry that burden for you, remember, the employer is giving you a benefit. And because the employer paid cash, whether transfer or check or whatever, but employer paid cash to the GRA, that component of tax which has been paid on your behalf constitutes a cash allowance or a cash benefit, which would have to be added to your income and taxed appropriately. We call it tax on tax. So it will be added back to your income and tax. All the allowances, of course, we have allowances, we have remuneration of employment gains and benefits, as I did mention under Section 7 of the Income Tax Act, which are not taxable. If those allowances are not taxable, for instance, medical, dental, and health insurance, if you enjoyed that and it's provided on a non-discriminatory basis, yes, that one is not taxable. So even if your contract says it's free, it has no effect on tax, so that's fine. If it is a reimbursement for expenses that you incurred for the proper purpose of business for your employer, that is also not taxable. But if it is an allowance which is taxable within the definitions of the Income Tax Act, Section 4, or any other allowance for that matter, and your contract says you should not be taxed, then it will not be lawful to do so. So the GRA will calculate all, add them, and then tax you accordingly. In terms of vehicle, as I did indicate, yes, when the GRA determines all your cash allowances, and I've explained what cash allowances are, together with your basic salary, we get what you call total cash emolument. So if your employer gave you vehicle, fuel, and driver, then you pay 12.5% of the total cash emolument will be added to the total cash emolument itself as benefit in kind. Luckily, this one is restricted. So you can, if it's annual, yes, as much as 18,000, and will be restricted to maximum of 18,000, and then will be taxed accordingly. So in conclusion, whatever arrangement that you do at the business level, the Commissioner General has right under Section 99 of the Revenue Administration Act to recharacterize it to give it a tax effect if that arrangement is seen to lead to a reduced chargeable income, or it's a way to avoid the payment of tax. The Commissioner General is clothed with the power to recharacterize it and give it a taxable color.
Okay, thank you, Eric, for that explanation. Our next question goes to Niamu, and it's from Henry. So Henry would like to know whether a company in the selection of a tier 2 provider, service provider for the first time, should do so in consultation with the employees. So essentially, if a company is selecting a tier 2 service provider, should it be the sole prerogative of the company, or they should do so in consultation with the employees whose contributions will be managed by the tier 2 service provider?
Okay, thank you very much, Lucy. Yeah, so you said Henry, right? Henry, yes. Yeah, okay, Henry. Yeah, so maybe just to give a background to pensions, the idea behind the whole arrangement of the scheme is that the employer, obviously being the facilitator, together with the employees, would make that arrangement that is supposed to be to the benefit of the employee. And so, in the view of the law, at all times, if there's any such major decision, from the initial time to even when an employer decides that let's change our service provider, the employee should always be involved in that discussion. It's the same with even at the scheme level. You see, when they want to change service providers, even for the board of trustees, member nominated, because they have employee or member representation there, it's assumed that members are involved in that decision. So at all times, any decision that is major that affects pension contribution, including selection of who your tier 2 or tier 3 service providers should be, employees must be engaged. Thank you.
Thank you, Ni. Okay, so our next question goes to you again, Ni. So it's from Priscilla. And Priscilla would like to confirm whether when a person goes on retirement, they will receive both a lump sum and monthly payments, or it's only monthly payments.
Okay, so thank you. So under the Act 766, if you are a contributor to the first year and second tier, definitely because it's mandatory and you're in the formal sector, you enjoy a monthly pension for tier 1 and a lump sum payment from tier 2. However, tier 1 will pay you a lump sum if you do not meet the minimum contribution period. I mentioned the change from 20 years to 15 years. So if you're not able to make minimum contribution of that accumulates to 15 years, SNET will pay you the accumulation of all the contributions you made plus returns, which is equivalent to 75% of prevailing 91 day bills. But I presume the reason why she's asking that question is with regards to what was done under the old law, where you have the option for 25% of your benefits to be paid upfront as a lump sum. So that responsibility has now been ceded to the tier 2. So in the normal scheme of things, tier 2 pays the lump sum and tier 1 pays the monthly pensions. Thank you.
Okay, thank you, Ni. So our next question goes to Eric. So Eric, so this question is also coming from another Eric. Yes, so Eric will want to know, is the 15% tax on PF partial withdrawal on the contributions made, or both the contributions and the returns made on the pension fund? So this is a combination of tax and pensions. So it looks more like a question for, yeah, it's Eric's question, definitely. There's pension bit in there, but it's Eric's question. So Eric, can you please answer that? So our participants would like to know whether they will be paying tax, the GR will be taxing them on PF withdrawal, partial withdrawal. They'll be taxing the returns made on that pension contribution. That's my understanding of the question.
Yeah, so from the structure of the law and then the amendment 1094, it is clear that it is on the withdrawal on the PF, it's withdrawal on the PF, because I don't know if Niamu will agree with me. The idea was to enable you keep the PF till the end of pension. The pension itself, I mean, generally is exempt, because those ones have been provided for in the Constitution. But then is the portions, the PF, the part that you are allowed under the the Pensions Act to put aside, is the part which we are saying that if you should withdraw, before the stipulated time, then it will attract 15 the tax. So it's on the PF.
Okay, so Eric, if I can clarify the question. So I think what our participant is asking is this: for example, if they have contributed 50,000 into tier 3 and they are withdrawing before 10 years, that's the 10th year anniversary.
Yes.
Let's say this 50,000 had accrued returns of, let's say, 10,000. Are you going to tax both the 50,000 and the 10,000? I think that's what the person would like to know, whether you'll be taxing the contributions as well and the returns, or it's just the returns that will suffer the 15% tax at that stage.
Oh, okay. But it's the same thing. I mean, we tax all together because that is the total amount which is available to you. Because when you were putting it there, we didn't tax it.
Right, yes.
When we
Thank
were
you.
putting it there, we didn't tax it. So this is the time that, so it's a deferred kind of arrangement. You know, Niamo and I have spoken about that when you're deducting that money into the provident fund, we don't tax it. So we defer it to the point that you wouldn't wait till it's matured and you want to take it, then the tax will come in.
Okay, thank you, Eric. And Ni, if you could please take our next question. So our participants would like to know whether an individual who is 47 years and has contributed to pensions for 22 years can withdraw his pension contributions at age 47, or they need to wait until they are 55 years or 60 years.
Okay, thank you. So for the tier 1, your the earliest you can take your pension once you are working is 55 years. That's the earliest you can take it. For tier 2, you can take it as early as 50 years, but the condition is that you should have been unemployed and you should submit yourself to the Labor Department to confirm that. You will also confirm that with SNIT. However, if you go on retirement, let's assume you go past 50, you go on retirement with SNIT between 55 years and 59 years, 11 months. Once you are retired on SNIT, you can also effect a retirement under the tier 2 because it will be viewed as retirement. Thank you.
Okay, so before you mute yourself, if you can look at this question for us as well. If an expatriate obtains an exemption certificate, but eventually gets their contracts extended beyond 36 months, because we know for you to have the exemption, you should intend to work in the country or stay in the country for up to 36 months. But
36 months.
Yes, but now their contract gets extended after the end of the 3 years. Do they need to start contributing to the pensions, and when should the contribution start from?
Okay, so typically what has happened, which is practical situation, is when that situation is about to arise, normally what they would do is to write, especially they already hold the exemption, they would write to us explaining the situation and request for an extension, and we would extend the exemption for an additional period.
Okay, very well. Thank you for that explanation. And
thank you.
Okay, so Eric, I'm coming back to you again. So there's a question on loans, and you went through the loans benefits and how to calculate the tax on that. So this question is asking, if an employee obtains a loan from a bank and the employer pays off the interest on the loan, does it fall under the purview of the loan benefits in kind?
Okay, thank you, Gifty. And the answer is no, in the sense that the employee secures his own loan. And all that employer came in to do is to pay the interest for the employee. And the employer paid cash. So the interest paid becomes a cash benefit to the employee. But if there are two sides of it, it is not a benefit in kind. It is a benefit in cash. One. Secondly, if the employer adds that benefit to the employee's income and taxes that, then the PAY will be paid on the interest together with his remuneration. It will be part of the total cash emolument. Then the employer too can take that as an allowable deduction. So there are two sides of it. That's how you treat it. But it will not come under a benefit in kind, because when you look at the definition, the arrangement, this one will not qualify to be there.
Thank you very much, Eric.
Okay.
I was trying to unmute myself. Yes, so okay. So our final question, unless we receive any more questions from our participants, our final question goes to Ni. And Ni, the question goes like this. Does an individual who holds a dual citizenship, let's say Ghana and the UK, qualify to apply for exemption from pension contributions if they meet all the necessary conditions?
Okay, thank you, Gifty. I believe the dual citizenship seems like a complication, but I believe it depends on how the employee is categorized here as a worker. If they are categorized, even though they hold the dual citizenship, if they are categorized as a Ghanaian working in Ghana, then they'll be viewed as a Ghanaian and not as an expat. But if they are categorized as a British or an English person working in Ghana, then they would be an expatriate worker. That is if the employer recognizes them as such and they are employed under those conditions. And then the other requirements that they would need to meet for the exemption would now have to be submitted for the exemption. So it depends on what citizenship, under what categorization that they are employed for. Thank you.
Okay, thank you for that clarification. So we do not have any more questions from our participants, but I will still give a chance for anyone who wants to raise their hand and ask their question themselves. Other than that, we'll take some closing remarks from our participants and then bring the session to an end. We are slightly behind time. So Franklin, would you like to start? Give us some closing remarks, then we'll move to Ni and then Eric.
Thank you very much. I think the program has been very insightful and educative to all businesses and individuals within the Ghanaian tax, how do you call it, jurisdiction. Most of the things that have been spelled out concern all businesses, one way or the other. Every business can identify with what challenges they face within the presentations that have been made. For me, one needs to be proactive in addressing and updating the tax laws, seek professional advice where they are not clear. If anything is ambiguous to define or to treat, just make sure you get clearance from the GRA authorities in writing and then follow suit. That will help businesses. If we are all proactive in following up with the updates, ensuring our reconciliations are done on timely basis, then there will be no need to incur any unwanted tax liabilities, as well as fines and penalties. Thank you very much. I want to thank the UK GCC for organizing this particular educative event, and we expect to see more. This is very, very good and cuts across all businesses. Thank you very much. Thank you.
Thank you, Franklin. Over to you, Neil.
Okay, thank you very much for the opportunity again. It's always a pleasure to speak about pensions. As I mentioned, it's one of our functions. Not to scare anybody, obviously to educate and also to highlight the benefits that are available for each worker, but also to raise the concerns that employers need to keep their eyes on so that they also do their best by their employees. I'm actually very happy to have been asked to be a panel member because I've actually learned a lot from the tax and the employer perspective. And I believe the resounding advice is that you should get expert advice and be conversant with the laws that apply and ensure that whatever systems you use are adapted to the laws. Mother law being the Constitution, I mean, it's very grave to breach it. And so as an employer, as a business owner that is entering a space, I think you should take the right steps towards meeting the requirements of these laws. Thank you. Thank you to UKGCC and also to PwC and to my panel members. Thank you.
Thank you very much. Eric? Yes, over to you.
Yeah, so let me start with where Ni ended. First of all, thank you to UKGCC. Thank you to our listeners or participants. And thank you to my colleague panelists and to you, Gifty. But then I would go on to say that tax, much as I appreciate that it's a difficult thing, it's a price that we pay for a civilized society. It is the tax money that the state machinery use to run itself for all the benefits that we get. I wouldn't, this is not an opportunity for me to list them, but school, hospital, security, and everything. I mean, the list is tall. So it is important that we take our tax matters seriously. And for PAYE, much as the business community is paying theirs, investment community is also paying theirs, it behoves on the PAYE community, so to speak, to also consider theirs as very important matter. The reason being that we are all, together with GRA, we are all partners in national development. And GRA is your partner. Fortunately for this afternoon, we've been advised that we can engage consultants, and we look around, and PwC has just given us a word. So where you are in a difficulty, I like the advice given by Franklin. Get them to assist you, and our doors are always open. GRA, we have moved to your doorstep. Now we are online, unlike before. Most of the information you can get them online, and even where you have a difficulty, yes, I agree with Franklin. I agree with Ni and Mutu. Walk to our offices for an advice. It is important to end by saying that once you do the right things in accordance with the law, you become a law-abiding citizen, and you have no issues with any law in Ghana concerning taxes. You can also apply for all the reliefs that I've mentioned. You can also apply for refunds where the case, I mean, as the case is, you can apply for a refund. You can also apply for a tax client certificate to transact your business, I mean, as and when appropriate. And it's important to know that when you do all these ones, when you register with the GRA, when you file your returns on due date, when you pay your taxes on due date and a correct amount, it is important to know that you avoid every potential penalty or interest. And in the unlikely event, you avoid prosecution as well. So I'll end here by thanking all of you and urge all of you, including myself, we all pay taxes. And it's the little drops of taxes together that will make Ghana a mighty nation. Thank you and good afternoon.
Thank you very much, Eric. And on behalf of the UKGCC and PwC, I also thank you very much, our panelists, for honoring our invitation and sharing your vast knowledge with us. We've all learned a lot from this session, and we look forward to engaging with you in the near future. I also like to thank our participants for joining us, not just for this session, but for prior sessions as well. And we loved your questions. Keep them coming. We'll share our contacts in the chat box and let us continue to engage beyond this afternoon. Also, we encourage you to follow the social media handles of the UKGCC on Facebook, on LinkedIn, and the rest. Feel free to follow them, and then you'll be receiving prompt updates as and when they are shared. Similarly, we'd like you to follow PwC Ghana as well. We're on Facebook, we are on LinkedIn, and we look forward to engaging with you. And to conclude, I would say that we have a team of tax professionals who are always willing to listen to you and help you to engage better with the stakeholders. So let us not stop engaging. Let us continue with the engagement, and we look forward to having another quarterly session in 2025. On this note, thank you very much and have a good afternoon.